Hello all, I hope you're doing very well in these unprecedented times. Welcome to the Fintech Finance Virtual Arena where we are joined today. I'm going to go for it, Nina Kerkez. Is that...
That's good. That worked. Yeah, that worked. That's fine.
I'll take that. I'll tell you that. We're joined by Nina from Lexis Nexis Risk Solution. How are you doing today, Nina? Whereabouts in the world are you?
I'm in London. I'm stuck in my little four walls in my flat in London with my puppy, which was a lockdown puppy, like many other people have decided to do that. But yeah, definitely not a lockdown decision, but a lockdown puppy.
So what kind of puppy?
He's a toy poodle. I've sent him with a borrow my doggy girl so that he can let us actually do some work. Otherwise, he'd be jumping in the background over there.
Well, we want to talk a little bit around, we're going to be talking about a lot of things today, but one of the things I want to kind of kick off the discussion with is financial inclusion. And by that, I don't just mean, first of all, to our friends, if there's anyone from Kuda Bank watching, congratulations on passing the 1 million customers in Nigeria. Fantastic. That's a great example of financial inclusion. That's getting everyone a bank account. But it's not just about that. Financial inclusion is, in my opinion, it's the cornerstone as to what fintech is about. But at its fundamentals, how would you describe what financial inclusion is and how that definition has really changed over the last 5-10 years?
Yeah. So financial inclusion definitely kind of means that individuals and businesses have access to useful and affordable financial products, financial services, and all of those are supposed to obviously meet their needs. And when I talk about financial services and products, it's, your classic transactions, payments, savings, credit cards, and so on. And so those are supposed to be delivered responsibly to consumers, whether those consumers are individuals or businesses. Now, being able to have access to a transaction account, so your kind of current account, is the first step in that financial inclusion. So just what you mentioned there absolutely helps with financial inclusion. And that kind of allows people to store money. It allows people to send money and to receive payments. But financial access, in essence, facilitates our day-to-day lives. It helps families, it helps businesses plan for kind of their objectives long-term, for their goals and for unexpected emergencies. We all have been put in a situation like that fairly recently, unfortunately, with the pandemic. And unfortunately, a lot of people have lost their jobs due to the pandemic. But with that, we're hopeful that, given that they have been financially included, they do have some savings which will help with that emergency. Now, as account holders, people are more likely to then use other financial services. So they're more likely to apply for credit, they're more likely to apply for insurance, they can start businesses, invest in their own education, invest in health. And ultimately, financial inclusion improves our quality of life and everybody's lives. According to World Bank, there has been a lot of actually movement in this space. So there are a lot more people that are now financially included in comparison to what we've seen, as you said, 5 to even 10 years ago. In the last 10 years, 1.2 billion adults worldwide have gotten access to accounts. So that's kind of the last 10 years movement. So almost 70% of the population has access to a bank account. But there is still that, almost a third of adults, so 1.7 billion, again, according to World Bank, are those that are still unbanked. And those that don't have the access to some of these traditional products in the financial world that I have been talking about. So that's really where the challenges are today when we talk about financial inclusion.
I am so glad that as well as individuals, you said businesses as well.
Businesses, yeah.
That's often like a completely overlooked element of it. I remember about 5 years ago chatting to the guys at Penta who in the UK, and they were saying, yeah, we just want to open a business bank account. It shouldn't be this hard.
Yeah. I mean, I kind of have a bit of a funny story about my dad. I don't know if I can tell this, but I mean, I can definitely tell this. So I shouldn't be going down this path. But yeah, my dad has a business that's a UK registered business, but he's not a UK resident. Him and his partner operate within the EU, and my father is not an EU member. He doesn't come from an EU country. And they have been struggling to open a bank account in the UK for their business, simply for the reasons that I just mentioned, that he's not an EU member. And therefore, as soon as he starts applying, it's kind of like all sorts of like red flags and alerts popping up. But they're they're a legitimate business. The information about them is fully available on Companies House. They post their financials, everything's operating fully legitimately, but still they're struggling to open an account in the UK, which just, is making it a lot harder for them to do business. Well, at that time within the European Union. Now I don't even know what's going to happen with Brexit. That's a whole other story. But, definitely a challenge.
It's definitely an overlooked section. One thing I always find fascinating is when you start to get a digital record, you can then have that data, and that data kind of lowers the level of risk when things for lending. And I mean, there's ever increasing ways to improve people's access to financial services, and it all comes down to mitigating risk against that. How does this kind of play into financial inclusion in terms of lowering the overarching risk and where data plays in that?
Yeah. So improved access to kind of financial services overall improves economic outcomes in most cases, right? So it's not surprising that we are seeing developing economies actually invest a lot in making financial inclusion their priority. There are a lot of fintechs, there are a lot of micro lenders that are appearing in the market, and there are other institutions that are similar to them. They're all trying to kind of improve this financial inclusions. I think where we have to ask ourselves, is, especially as an industry, how we're doing is when it comes to large scale financial institutions. So what are they doing to improve the financial inclusion? And we know that kind of as an industry, we need to screen our customers when we're onboarding them. What that means is we need to understand who they are as a part of that onboarding process. So as a financial institution, which is normally regulated, they need to understand who their customer is. And what we have kind of seen over the years is that there is more scrutiny on what that process looks like. But there is also more scrutiny on what is kind of deemed as an acceptable individual or business. So similarly to the story I just told about my father, it kind of, there are things that are considered red flags or higher risks for businesses when we talk about financial inclusion or onboarding. So issues arise when somebody is deemed risky, and it's often based on those background checks, lack of credit in that country, short residence in that country. Let's say you're a student, you just moved here, you're trying to open a bank account and you're struggling because there is no data on you. I don't know where you came from, but you don't have a lot of data that's linked to you in this country. And so therefore, all of these elements present this person as kind of a risky person for the business. So what we see is that, entities, whether individuals or businesses, are being rejected from being allowed to have access to financial services. But in fact, what happens there is that increases the risks of wrongdoings. And actually, it doesn't allow us to learn more about that person and their financial behavior. So if we don't include them in the financial system, we're only, not going to learn about them. We're going to know less about their behaviors, especially online. And then these individuals, if we are talking about individuals, are more likely to start moving cash and operate in kind of cash-only ways in society. They're not really allowed to rent properties or struggle to rent properties. They have no access to healthcare, so on and so forth. So we are creating a lot of societal issues with that. So in a roundabout way, I guess what I'm trying to say is that data is very important. Data is the king. And I know people have been talking about that for a really long time, but we really need to rely on data and information to kind of try and understand, about people, to try and understand about businesses, to help onboard them and understand the risks that true risks that actually are associated with them. And often risks of an average individual are very, very low. And, when we think about what it is that we could be looking for is potentially some alternative data and some alternative behaviors. So, whether it's their online behaviors, their likes, their dislikes, kind of knowing the customer in such way can absolutely help mitigate those risks that the financial institution could be facing. I am conscious that issues around data privacy exist. So there are a lot of data privacy regulations out there, but we need to be thinking of what it is that we're trying to achieve. So we're trying to eliminate some large societal issues with this. And in those kind of cases, I guess, helping deal with these societal issues should be trumping some of those data privacy challenges. And I'm sorry to use the Trump word, but I couldn't think of any other word to use there.
No, that's absolutely fine. See, I was thinking, as a bank, you just let Experian or Equifax just let them deal with it. Well, what are some of the other alternative parts of data that banks need to have? Because they should have a huge amount of transaction history and know a lot more about you than perhaps Experian or whoever may do.
Yeah. So, well, in order to kind of be scorable by these credit bureaus, you have to have a credit data footprint. So you need to be actively participating in a banking and credit system. And the issue here is that, these people aren't. So alternative data refers to a data set that could be used for credit decisions and fraud decisions. And some of those alternative data sets could be very, like a lot of different things. So public and institutional data, such as educational history, such as criminal history, any kind of professional licensing. So, I have ACAMS certification, for example. I've studied, I have a couple of masters. So you can kind of look at my history and see whether, what that looks like really. You could be looking at property assets, some ownership assets around properties. You could be looking at the locations of where these people are living. So there are often kind of economic trajectories that are associated with the locations. You could be looking at some court data as well. So, bankruptcies, evictions, and that kind of stuff that could indicate and showcase some other alternatives when it comes to risk scoring individuals and businesses. And also, I really do want to touch on digital data. And I think digital data is so important for us, especially in trying to kind of deal with the challenges of credit risk and fraud. And when I talk about digital data, it's about somebody's digital behavior. So what does my digital behavior look like? Where am I accessing my accounts from? Which kind of tools am I using to operate online? Looking at all sorts of information that we could gather now digitally to understand this person and potentially some of their behaviors online. So I guess as a result of kind of not, so kind of going back to those credit institutions. So as a result of not giving or not including people in the financial system, we end up with underserved customers, and they will actually lack traditional credit portfolios, and they will be unscorable by these kind of traditional credit data sources. They could therefore be declined mortgages, loans, any other financial services that are very important. And what we do at Lexis Nexis Risk Solutions, but there are a lot of other kind of alternative data vendors popping up in the market as well. We build risk scores, and they allow our customers to look at numerous kind of alternative data assets that I've just mentioned. And so therefore, financial institutions could make an informed credit risk decision. And of course, that will help increase that financial inclusion and transparency.
Absolutely, and it also again opens up a lot of other doors. The joke I always hear is my bank won't trust me to pay £800 pounds on a mortgage every month. So I'm now paying, or as I have for the last few years, 1,200 a month. With this in mind, how will alternative data using, say, something like the rental space and mortgages, for example, how will that improve financial inclusion for those that already have a bank and already can show that data? How can that data that the banks have be used to go, actually, we should probably give this guy a mortgage because he's been paying, an extra, 125% or 150%, whatever, for the last few years?
Yeah, since I've been given a mortgage, I've realized how many other expenses there are that are linked to it. So I'm not sure about that one, but I absolutely get what you're saying. I was also one of the frustrated payers of rent for a long time myself in London, and that's not a cheap rent. So kind of speaking to the alternative data assets that I've touched on, if I as a financial institution could understand my customers' behavior and I understand their behaviors and spending, I've included them in the financial system. That data is exactly what can help serve these underserved customers. So one of the key use cases for alternative data has been the ability to kind of rank order consumers who have not had that traditional credit data footprint. And at Lexis Nexis, again, we have done some analysis, and the analysis that we perform specifically in this field demonstrates that 1 in 4 consumers in the general population can fall in this group. So they are kind of underserved in the financial world. And the highest scoring of those 1 in 4 consumers, so 64% of them, actually represent the low risk population. So that low risk population is likely to be good and profitable customer for lenders and credit card issuers. But lenders, credit card issuers, and financial institutions in general have to be using that alternative data, and they have to be looking at the alternative data to understand that customer in such way, rather than just some of the traditional data elements, which we have seen in the market for many, many years. So it simply indicates that credit worthiness, that these underprivileged customers perhaps are credit worthy. So, they could also be profitable for their business as well.
Absolutely. I want to kind of look at, there's 2 examples that spring straight to mind for the kind of the next point. Alipay and WeChat Pay in China, phenomenal way of starting to get data on what was way back when a predominantly cash-focused society. But also Nubank in Brazil, which is quite possibly one of the most successful neobanks out there. With such a dramatic impact that these types of organizations have had in their domestic markets, and building up that improved data file on everyone, could this sort of snowball credit, if you like, in a greater fintech revolution than we've seen with just kind of neobanks and current accounts? What's kind of the scope of what could be achieved by banks mitigating risk and using data using the data they already have on file in a very sensible way?
Yeah, I mean, it's interesting you mentioned those businesses, and as well, some of the other tech giants, if they kind of considered helping this space, they could really have a significant impact on financial inclusion. But it's not their priority, it's not their core business, so they don't, but they, sit on the wealth of data. And as I said, data is king in all of these situations. So, the alternative data is there. So what we need as an industry is definitely more awareness, kind of better usage of this alternative data. So potentially, I guess, there could be a significant impact, but we also live in a world in which financial stability is currently shaken. We are, kind of potentially coming out of a pandemic. I'm kind of scared to say that, but we are facing some difficult times, especially as we do start coming out of the pandemic. And there will definitely be greater need for lending. We know that the job unemployment is at its highest, not just in the UK, but globally. And so will lenders be open to that, to actually issuing, kind of more loans to these individuals. I don't know. I'm not sure. So what I think we could see certainly is an increase in this fintech sector, is an increase in other alternative micro lenders popping up in the market. However, those also need to be vigilant. They need to also understand their customers. So yes, you're a micro lender, so maybe it's easier for you to lend, but you should be looking at other data sources and alternative data sources to understand your customer, so that you mitigate your own risks that are associated, with that prospect customer. So I don't know. I mean, I think it's a tough question to answer, but I think it's definitely a space to watch, and I mean, there could be a massive change in the fintech world as we start getting out of this crazy situation we're in right now.
Flip side, this kind of focused on get as much data as you can. We did a study on a bank in North America, and they had a loan AI machine, but it had been fed previous data from the bank. And so various prejudice that was on the previous data was then automatically fed through and almost amplified by the kind of the machine learning around that existing data. What are some of your thoughts on the implications around these types of inequalities when it comes to inclusion, but also economic empowerment?
Yeah.
A nice easy one for you.
I am very passionate about this topic. Being a woman working in the financial services space, I mean, I am, what we know is that kind of half of the unbanked people include women from poorer households in rural areas, women that are out of workforce. It's not just women. There is definitely, inequality when it comes to race and other issues that kind of surround that, diversity when it comes to financial inclusion. But the gender gap in account ownership actually remains stuck. So again, World Bank does a lot of research on this. And this is hindering women from being able to kind of effectively control their financial lives. And what we are seeing is that countries that have high mobile money account ownership have less gender inequality. So we are kind of hopeful that the world will start moving in that space. But whilst significant progress has happened in the world of financial inclusion, so as I said, over the last 10 years, we've seen a significant increase in financial inclusion and a lot more people opening accounts. What we know is that that kind of gap, the gender gap, has not decreased. So 72% of men have access to accounts, while only 65% of women have access to accounts. So that kind of gender gap over the last 10 years absolutely remains unchanged, which is quite sad to see. And also, I am conscious that the implications of pandemic could further increase, that gap, and we are seeing a lot more, perhaps, women coming out of workplace to kind of deal with a situation that they could potentially have at home, whether it's homeschooling children or just dealing with the tough life that we're all presented with right now. So including financial inclusion is important. Including women in the financial universe is extremely important, has positive effects on society. Women can contribute to growth significantly. They can build businesses. They can also better manage their financial resources, which is very important. I am not very good at this myself. Being a woman, we're known to spend more than men on, all sorts of accessories. But I think it's extremely important to start thinking about, and I guess there's an issue of this kind of, some traditional elements of like men manage money, right? So, and it's still, we kind of still live in that society, although things are slightly changing, at least in the Western world. But extremely important to plan for those, to have savings, to plan for those emergencies, to plan for like pensions in future. And we also know that today, traditionally, people don't always stay together until, forever and ever, and until the end of their lives. So, and unfortunately, we don't, we see women being left underprivileged in those situations, and that's not what we want. We want them to be economically empowered, and we want them to definitely get involved in opening businesses and starting businesses. And women are amazing at doing all these things. So we need to do better as a society with gender inclusion when it comes to financial inclusion.
Absolutely. And taking any kind of taking morality off the table, it's a big market. I mean, that's a huge opportunity there, just fiscally, and it's also a market that is present in every country in the world.
Absolutely. Yeah, well, look, I talk to women because, as I said, it personally affects me, and I am, interested in this. The FCA is just about to run a tech sprint that's focused on economic empowerment of women. It's coming up in March, so I'm really excited to take part in that. They're also looking for women in technology to obviously help with the hackathon, but that's also another challenge. We kind of talk about the jobs that are out there, and we do live in an increasingly digital world, but women still are underrepresented in STEM and underrepresented in technology, and it's not great, because that's where our jobs are moving. We're moving away from some of the traditional elements of kind of the workforce out there, and we need to be able to give jobs to those women as well. So the more diversity we have in teams, not just male, female diversity, those teams tend to often perform better, because there is just a lot less groupthink and conforming to same ways of thinking. And so teams that are challenged perform better normally.
Excellent. Well, Nina, it's been an absolute pleasure speaking with you today. I've definitely learned a lot around financial inclusion, but also on the risk side of things with data. Where is the best place to reach out to yourself?
Well, you can contact me on LinkedIn. It's very easy to find me there. Just go to LinkedIn /Kerkez, if you can spell that. Alternatively, you can also contact me on my email, which is nina.kerkez@lexisnexisrisk.com, which is a mouthful, but maybe there'll be some writing at the bottom of the screen now as I say this out loud.
Do you want to do a quick little action?
Yeah, nina.kerkez@lexisrisk.com.
Awesome. Thank you very much.
Thank you.